Hi, and thanks for joining our first quarter market outlook. My name is TJ Kistner, and I am the Chief Investment Officer at Retirement Plan Advisors. Today, I'll go through market performance for the first quarter of 2024, as well as discuss our forward-looking views across asset classes. We hope you find the discussion helpful and informative. The fourth quarter of last year saw tremendous growth in both stock and bond markets as investors became euphoric at the idea of the Federal Reserve cutting interest rates in the coming year. Much of the excitement in equity markets continued into the first quarter as the soft landing narrative took hold. But over the course of the quarter, a number of inflationary indicators were hotter than expected, and as I'll illustrate in a moment, the bond market told a different story. As we look at asset class performance, the table at the top left illustrates returns across U.S. equity markets in the first quarter, while the table at the top right shows the same returns for the full year 2023. As you can see, many of the themes we saw play out in 2023 continued in the first quarter of this year. Namely, large caps outperformed small caps, growth outperformed value, and the U.S. outperformed international and emerging markets. The S&P 500 seemingly went straight up during the quarter with very little volatility, as the index set 22 new all-time highs in the quarter. There are a number of explanations for the continued dominance of U.S. stocks, most related to the higher quality of the largest tech-oriented U.S. companies, but the continued dominance of large cap growth has many investors questioning whether or not this part of the market is in a bubble. Emerging market equities continue to lag, primarily driven by continued weakness in the consumer and real estate markets inside China. I mentioned bonds had a different experience in the quarter, returning minus 0.8%. A number of hotter than expected inflation reports during the quarter caused interest rates to rise across the yield curve, as illustrated on this slide. This caused investors to push back their expectations of the timing of interest rate cuts and put pressure on bond prices. Turning to our forward-looking views, we certainly felt as though the market's expectations for 6 rate cuts in 2024 was overly optimistic. In addition, recent inflationary data has called into question the timing and velocity of interest rate cuts. At this point, we feel as though the bigger question is not when the Fed will cut rates this year, but if they will cut rates. If inflation remains stubbornly above the Fed's 2% target, the unemployment rate remains low, and economic growth remains strong, it's very hard for the Fed to justify cutting interest rates, for fear that doing so could reignite inflation. Because of this, we remain neutral across equities and credit, but have moved our view on treasuries back to neutral. While overall yields across the curve are attractive, we are less convinced that interest rates can drop materially in the current environment, which dampens the total return opportunity. At this point in the cycle, we think Fed policy and interest rates are the overwhelming driver of both stock and bond returns, and we will be monitoring both very closely moving forward. Switching to our global asset class views, we remain neutral across equity markets. The continued strength of U.S. large cap, particularly in growth companies, has further stretched valuations in the market, gives us pause. We do think that smaller companies can perform better in a period of broader economic strength. But given the uncertainty around inflation and interest rates, we're not yet ready to overweight small caps. We have, however, broadened out our U.S. large cap exposure to trim positions in the areas of the market that have significantly outperformed and redeploy that capital in areas that are more attractively priced. Within fixed income, I mentioned we've moved our outlook on treasuries back to neutral, and that is also reflected in our views on U.S. core and long duration bonds. We remain neutral across areas of credit such as high yield, bank loans, and emerging market debt. But we do think that given current coupon rates in these areas, they could be attractive options within fixed income if we don't run into any economic speed bumps. Thank you for listening, and we hope you found the information helpful. And remember, the future is better than you think.